Everyone dreams of living freed from financial stress, where money isn't an issue. However, for most people, this remains a far-fetched fantasy. But what if I told you this dream could become a reality by investing in dividends? Yes, according to legendary investor Warren Buffett, dividends can be a powerful tool to help you live your best life. Welcome back to my channel. Join me as I share some strategies based on Buffett's principles and advice that could help you generate a steady income stream through dividends. With the right approach, you could earn $4,400 a month. These tips are based on Buffett's wisdom and experience. So if you want to improve your financial situation, stick around to learn more. Let's get started. Before I dive into the main detail, let's look at the meaning of dividends. Think of it like this: you invest money in a company, and by doing so, you become a part owner of that company. When the company makes a profit, it can distribute a portion of those profits to its shareholders as dividends. This provides investors with a steady stream of income over time. It is important to note that companies don't just randomly hand out dividends. While some companies pay out dividends quarterly, others do so annually. The specific schedule depends on the company and the agreement between the company and the shareholder. Dividends can be paid out in cash, like receiving a paycheck, or shareholders can use the dividends to purchase more company shares, increasing their ownership stake. Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." In a nutshell, dividends are a way to make money while you sleep. Dividends can provide a steady source of income and be an essential tool for building wealth and achieving financial independence. This is a strategy that Buffett himself has used to accumulate his fortune over the years. In a recently revealed letter to his shareholders, Warren Buffett said that his investments in the companies that offered dividends have significantly contributed to Berkshire Hathaway's success. For example, he mentioned Coca-Cola, one of his favorite dividend stocks. You might be wondering how to start investing in dividend stocks yourself. Buffett has some great tips to help you build a powerful dividend portfolio. The first step is to carefully research the company's history of dividend payments. Look for companies with a track record of stable or increasing dividend payments, as these are often found in sectors like consumer staples, utilities, and healthcare. It's also important to understand the company's financial health, competitive advantage, and ability to generate cash flow to sustain its dividend payments. By researching, you can increase your chances of selecting a stock that will provide a reliable income stream. The second step is diversification. Diversification is an integral part of any sound investment strategy. This means spreading your investments across different sectors and industries to reduce risk. In other words, don't put all your eggs in one basket. A well-diversified portfolio is less vulnerable to market volatility and downturns. It can provide a measure of protection for your wealth. Even if you're investing for dividend income, it's important to remember that the value of your investments can go up or down, so diversification is key. The third one is having a long-term mindset. One of Buffett's most important advice for dividend investors is to have a long-term mindset. He often says, "Invest for the long haul." In other words, don't get too greedy or scared. The most important thing is to create a financial plan and stick to it. If you have a plan and are disciplined in investing, you'll be well on your way to achieving your financial goals. It's like a snowball rolling down a hill. It starts small but grows larger and larger over time. Buffett's approach may not be flashy or exciting, but it's proven effective over the long term. The fourth one is to assess the risk of a dividend-paying stock. According to Buffett, when evaluating the risk of a dividend-paying stock, it's important to consider the company's debt levels and history of cutting dividends. Excessive debt or a history of frequently cutting dividends can be red flags that the company is not as financially stable as it seems. So, you should be wary of a company with a significantly higher yield than its peers. That's often a sign of trouble, not opportunity. It's better to buy a dividend stock with a lower yield that's rock solid than to chase a high yield that may prove elusive. Look for companies with a solid balance sheet and a track record of performing well in economic downturns. As time passes, It's also essential to regularly review your portfolio and make adjustments to ensure it aligns with your financial goals. By following these principles, you can build a powerful dividend portfolio that will stand the test of time. Now let's get into the main aspect of the video, which is how to be financially independent with dividends. The first approach is to invest in reliable companies. Look for companies with a solid balance sheet and a track record of performing well in economic downturns. These companies are called blue chips. Blue chip dividend stocks have long been a staple of many successful investment portfolios. These companies, often established industry leaders, are known for their financial stability, solid track records, and consistent dividend payments. For investors seeking income, blue chip stocks offer a reliable source of cash flow, as these companies tend to weather economic downturns better than their smaller, riskier counterparts. When investing in blue chip companies, you should consider their proven track record of resilience, competitive advantages, and history of rewarding shareholders with consistent dividend payments. Before investing in blue chip companies, there are some red flags you should look out for, including increasing debt levels or frequent management changes. These two can be signs that the company is experiencing trouble. Investing in blue chip dividend stocks is a perfect example of Warren Buffett's philosophy of quality over quantity. By focusing on companies that have proven themselves over time, you can create a portfolio that will provide a steady income stream for years to come. Investing in dividend growth stocks is another approach to living your dream life with dividends. While blue chip stocks are stable and reliable income generators, dividend growth stocks offer a unique advantage. These are companies that not only pay out dividends, but also consistently increase them over time. This aligns with Warren Buffett's maxim that the best investment you can make is in yourself. In the investing world, this translates to seeking out companies that invest in their growth and are committed to increasing their dividend payments. Dividend growth stocks are often found among companies operating in industries with substantial growth potential or offering innovative products and services. The key to dividend growth stocks is that these companies prioritize reinvesting their earnings into research, development, and expansion, all while still rewarding shareholders with rising dividends. One of the main benefits of these stocks is that they offer investors a steady income stream. Since these stocks typically pay out a dividend that increases over time, investors can also expect their income to grow. Also, dividend growth stocks tend to be less volatile than other stocks, so they can provide a bit of stability to a portfolio. In addition, dividend growth stocks tend to outperform the market over the long term, so they can be a good investment if you want to build wealth over time. Like Buffett himself has said, time is the friend of the wonderful company, the enemy of the mediocre. The third approach is to invest in covered call exchange-traded funds. Covered call exchange-traded funds are a unique and innovative investment option that allows investors to earn income from their investments while limiting risk. Here's a simple breakdown of how it works. Covered call ETFs invest in a portfolio of stocks from various industries and sectors, spreading risk across multiple companies. However, they also sell call options on the stocks they own, meaning they receive a premium payment from the buyers of the options. This premium is then shared among the ETF shareholders, providing them with a consistent income stream. This strategy allows investors to generate income without constantly monitoring the stock market. However, it's important to note that there are some risks involved with this type of investment. One such is that covered call ETFs may have limited capital appreciation potential compared to traditional dividend stocks. Besides the risk, they are the type of investment that can provide investors with a higher yield. This makes them an attractive option for investors looking to generate income with a smaller initial investment. In the practical sense, by using the covered call ETF method, you can reach your goal of earning a monthly dividend of $4,400 by doing a simple calculation. This is unlike the traditional dividend calculation method, which requires more complicated formulas. With covered call ETFs, you can use a dividend yield of 12% to find the annual income needed. First, multiply the monthly income goal of $4,400 by 12 to get the required annual income of $52,800. Then divide the annual income by the yield percentage, which gives you the total amount required for the investment, which would be $440,000. Although it takes time, commitment, and perseverance, building monthly dividend income is achievable. So remember that consistency is crucial. Do your research, enjoy the magic of dividends, and let your money work for you. Have you enjoyed this video? Hit the like and subscribe button for more videos like this. I'll see you in the next one.